All right. Today we are talking about if I had to start from zero, how would I begin investing? We're going to walk through every single step along the way, or if you're just graduating from college or you're just getting into the workforce, probably not starting with a lot of cash. So, how do you start saving it? How do you do it in a very specific sequence and order to set you up for the most success so that eventually you can be financially independent? And when should you start investing in Bitcoin and how? That's what we're going to look at today. So, this is a personal finance video that will lead into the appropriate time to make those investments into Bitcoin responsibly. So we're going to look at a whole bunch of different stuff, and I'm going to start where I started. This is the website. This was 15 years ago, okay? This is the website I found. I followed this sequence, and I'm going to tell you the things that I did do and the several things I did not do along the way, and the ways that you can tweak this to be the best for you as well, okay? So let's dive in. Bitcoin's going to be in the mix, but we're going to talk about when that might make the most sense. Okay, so this is the website. It is called My Money Wizard. It was literally me just typing around on Google. There was no chat GPT, there was no AI, and it was just, how do you begin investing? And then I found this sequence of order, the correct order for investing your money, okay? So why don't we dive into this? I'm going to zoom this in? No, we're good. All right, so number one, we're just going to work our way down this list, and I'm going to give you my feedback on each of these things. Build an emergency fund. 100% agree with this. There are going to be things that pop up in our lives. We need to be prepared. The best way to do this is to have an emergency fund. Most people recommend 3 to 6 months as a way to start. That gets you in the mindset of saving money right out of the gates, even if it's $5 a month, $10 a month. Start saving money. And what you should do is you should create, this should be automatic. Because if you get the paycheck, you spend the money, and then you try and save it, there might not be anything left. If you get the paycheck and you say, I'm going to put $100 a week, pick a number. I don't know what the number is for you, $1,000 a month. Whatever that number happens to be, you get the paycheck and you put that money away right away, and you don't touch that, because now it's forcing you to be a saver, and then you'll live within the rest of those means, okay? Build an emergency fund. 3 to 6 months. People go, well, how do I know how much 3 to 6 months is? It's a simple answer. You need to track how much money you spend. The way that I used to do that was with mint.com. That's no longer available. And so I use Monarch today. I link it to my credit cards. It links up to my bank accounts. It literally shows you every dollar I spend. It puts them into categories so you know where the money's going. And then you can understand what your burn rate is. So figure out how much money you typically spend a month and make that the first goal. Start by pick a number, $5,000 a month, $3,000 a month, $10,000 a month, whatever your number is. Make the goal to have that much saved up in available liquid. I used to play around with, do I put them in T-bills or do all this stuff? The answer is, if it needs to be that liquid, you can just put it in a high yield account, a savings account right here. I like Capital One. 3.6% is what you're getting today. It's better than any regular banking account because there's no change, there's no locations. So they're going to give you money because they're not paying a mortgage on their locations, right? So you get to keep more. So 3.6% is what it is today. I've seen it up to 4.75%. It changes, okay? But you're making some return on your money, and you're putting none of it at risk. And so you're saving your money. It's safe. It's FDIC insured. You're good, okay? Now, the other cool thing is you can set up a whole bunch of different accounts. So it's all in the same login, but you can create an account for vacation. You can create an account for saving for a car. You can create an account for whatever you want, and then you can create those categories. You're like, I'm not touching this, and it's all there. Rather than if you just keep it in one account, I found it's just easy to kind of jump in and grab money here and there. Set up different accounts for different purposes. It keeps things clean and organized, right? I really like that approach. So, number one, build an emergency fund. Start saving right away. You don't think you have any money because you're spending it. How much money are you spending? You got to figure that out. Those are all the steps to get started. All right. Now we're going to go to contribute to your 401k. So if you've got a job, they offer 401k. Your employer typically doesn't match. Typically, it's anywhere from 3 to 4, maybe 6%. I mean, the max is 8%. Typically, that's not the case. Most places are probably about 4% match. Go to the match. It's free money. Okay? You put $5,000 in, they put $5,000 in, right? Now, there's limits on there, but for the most part, they're going to match it. That's free money. That gets invested. It goes into your 401k. That goes towards your future. That goes towards retirement. Do it. It's a 100% return guaranteed. You take those. Okay? You don't fight those. You take those. So do that. That also helps you further live within your means because that money comes out before it hits your paycheck. Therefore, you can't spend it because it's already been invested. So figure out, talk to somebody in HR or however you need to get it figured out. Do the 401k up to the company match. Then I say stop. And this is where we're going to start getting a little more sophisticated here, okay? Because you might come back to the 401k, you might not, all right? So, and within the 401k, you typically have limited options, but you can invest in things like the S&P 500, you can invest in the NASDAQ, you've got options there, okay? So then the question comes, well, what should I invest in within the 401k? We'll hit on that. I'm a big believer in ETFs. Keep it simple. An index fund, Warren Buffett says, most people just invest in an index fund. I believe in that as well. Don't try and guess who the next Amazon or Google is going to be. It's a good way to lose your money. This is just money to be secure, know that you're going to survive. And the stock market has performed between 7 and 10% historically, the S&P 500. So just do that. Compound interest is unbelievable. Okay, so let's do this real quick. Let's go. We're going to go future value calculator real quick, and we're going to take a look at something here. I like this. We'll use this one. This is fine. Okay, so let's say that you start working, you got 40 years to your career. Let's just keep it simple. It's actually 45, right? Let's just keep it simple at 40 years, right? So at the age of 25, you retire at 65. Those are just easy round numbers, okay? Let's say you put, we're going to start with $0. The interest rate, the stock market, let's just say is performed at 9%. We'll do 9%. It's usually between 9 and 10%. Periodic deposit, let's say you do, what's realistic to start? 200, let's just say $200 a month. Or, there you go. So, $200 a month, we're going to go like this. We're going to say, 200 times 12 is 2,400. What does that turn into? Okay. So $2,400 a year. You do that for 40 years. You walk away with $810,000. You're gonna earn more money over time. People make it sound like it's so like becoming a millionaire isn't easy, but it's also not hard when you let compound interest do its work. Okay? You literally put less than $100,000 to turn a $714,000 gain. You can see most of those gains don't start kicking in until 30, 40 years down the line. But that's the power of it. So let's say you did 200. Let's see what it would take to get to $1 million. So 250 times 12. That's $3,000 a year for 40 years. You're gonna get pay increases, raises, and if you get a 10% increase in raise, don't spend 10% more. Say, I'm going to put 20% of that towards my future, this investing. I'll keep the other 80% that I'm going to spend and enhance my lifestyle. Cool. All right, here you go. $1 million. $250 a month for 40 years gets you $1 million. Congrats. Pretty cool. Now, what do you invest in within that? I think you can keep it simple. You can go with SPY. That's the Fortune 500. That's the 500 largest companies in the United States. Or you can do QQQ. That's the NASDAQ, and that's more heavily weighted towards tech stocks, more volatile, but bigger returns. So let's take a look at this. Here is a chart looking at this one here, Those candlesticks, this one, the red and the green, that is SPY. That's the Fortune 500. Okay. This is starting in, what year is this? 2018. We just picked the date. Over that time span, that has kicked, so what's about 7 years? That is provided a 96% return. Not bad. Here's why I like Triple Q, the NASDAQ. It is more volatile. Look at these ups and downs. They're bigger, but look at this trend. This purple number, 164%, is better than 96%. You just can't get scared in these downturns because it's going to be more volatile. But look at this. It is on the like almost identical trajectory because a lot of these stocks are the same. These are just more heavily weighted towards the tech stocks. I believe tech is going to be around and successful going forward. So you can see the same type of pattern here. You just get more juice out of it. I like Triple Q for that reason. Okay. And you may or may not have direct access to that in your 401k. Ask around, ask HR, whoever's managing that for you, what your options are. They are going to be a little bit more limited, but there you go. All right. So you do that up to the match. What do you do next? Okay, this says pay off credit card debt. First of all, our goal is to stay away from as much credit card debt as possible. That's consumer debt. That's bad debt. Okay, you don't want that because the average credit card carries a 16% interest. That's more than the stock market's kicking off. Okay? And I get it. Some years will be 24%. I mean, in 23, it was 24%. In 24, it was 23%. This year, it's not trying to be that high, right? Over the long term, it's about 9 to 10%. So pay those credit card debts off. If you're doing it right, you're paying yourself first. You're saving money. You're being mindful of your spending. You know how much you're spending because it's so easy. All of a sudden, you're like, dude, how did I spend that much? And you look at the list. You didn't make any big expenses, but it's just little stuff. All this little stuff adds up to a big number. Try and stay out of debt. Try to pay your credit cards off in full every month because you get the benefit of the credit card points, right? You can use it for hotels. You can use it for flights, all that kind of stuff. But if you do it, do your best to try and pay it off. If you do have credit card debt, pay it off because it is a guaranteed 16%, whatever your interest rate, it could be 18%, whatever it is, that's a guaranteed return that's outrunning your other numbers. The whole goal is based on just interest rates and returns. You just want to have the best return possible, right? So 16% return, guaranteed. If you pay that bad, and once you get out of the debt, try not to go back into it. I get that. But there you go. Pay off the credit card debts. Number 4, pay off high interest rate debt. Again, the whole thing is, now this says anything classified above 4 to 5%. That's U.S. Treasuries. I get that. People talk about the snowball effect. You get all excited because you start paying down the lowest amount of debt and blah, blah, blah. My whole theory is that feels good, but that's not how numbers on paper work. So you pay off high debt, okay? Whatever's above, they say the U.S. Treasury rate. Yeah, I get that. So be mindful of that option as well. That's a good one. The goal is to try and get debt-free as quickly as you can, and then start maxing out those investments. So max out your HSA. I love this one. This one's unique because it is the only one that is truly not taxed either on the front end or on the back end. So typically, you got to have a company, you got to have work for a company or have an option where you can invest in HSA. It's not a guarantee. You have to have the option. And you have to have a high deductible, all this stuff to qualify as part of your health insurance. But I like to invest the money. So you can put it away and then you can use it for your health events as they come up. But if you're out of debt, you're saving money, you're living below your means, a lot of times you can just pay for that stuff out of pocket. And this is cool because what happens in your 401k, you can either do a Roth or you can do a traditional. Okay? So a Roth means you make money, the government taxes you on the money, so they've already received their tax money, and then you invest that money, and anything you make after that is yours. There's no taxes on the back end because you've already paid it on the front end. The reverse of that is what happens with a traditional IRA. So you make the money and then you invest the money, okay? You pay no taxes because you invested right out of the gates. When you take the money out, that's when you pay the taxes, okay? So there's debates on which way you should go. I prefer Roth IRAs because I believe, I don't know, you can pay the tax on the seed, right? Like, hey, I'm gonna buy these seeds and have them grow, and then whatever money I make on this corn, that's all mine. I'm gonna pay the money on the seed, the smaller amount. Some people say, well, I'll pay I'm gonna buy the seeds, I'll have more seeds, I'll let that grow, and then I'll pay the tax on this higher thing. That's not the best analogy, I get it. Do your own research on if a Roth or a traditional is better. I personally like Roths more. You still get taxed at some point, and that is on the front end. With these HSAs, you don't get taxed on the front end. So it goes from your paycheck into your HSA account. A lot of people think that's just there, it's in cash, it's available if you have any medical needs. That's not the case. You can invest that into stocks or ETFs or anything you want. Or not anything you want. Within limits, you can invest that money. The cool part is when you take it out for medical events in the future, it's not taxed again. It's unbelievable. It's one of the greatest tools there is. There are limits on it. I believe it's $7,000 or $5,500. Look it up. It kind of changes from year to year. It's unbelievable. I highly recommend it if you have the ability to do it. Again, what this does, this is just another way of saving before the money hits your checking account. Because you're putting this money in every month, it's really making you, again, live below your means and be a true saver. So I think it's a great tool. You can invest in SPY, you can invest in MSTR, you can, we'll get there, Bitcoin, ETFs, all that kind of stuff. Check that out. This is where I diverge from this list. Then it comes back to max out your IRA. And this has to do with your risk profile and what you believe in, okay? For me, when I was in the corporate world, I would do all of it up until this point, the HSA. I would not go back. I did not max out my IRA. No, I'm sorry. No. I would do this. I would max out my my Roth IRA. I would do that. Or you could do backdoor IRA if you make over a certain amount of money. I would do that. Sorry. Yes, I would absolutely do that. I think it's a great tool. And again, you have more freedom in your personal IRA. A Roth IRA, I think, is great. Fidelity, Vanguard, there's all these different options. Max that out. And then you can invest that money and you can put it into all sorts of different stuff. Do that. This is where I did not follow. Finish maxing out your 401k. I didn't do that. I went up to the match and I stopped because then I was forced back into a limited pool of investment options within the stock market. And I wanted more diversity and the ability to access money sooner. So if you had 15 million bucks in a 401k, and you're 40 years old and you want to quit your job, I'm sorry, you can't touch that money without taking penalties. How are you going to pay the bills? I wanted something that created more cash flow so that I could create financial freedom sooner, that was very accessible, and I believe I had more control over and had the ability to earn more money than the stock market. For me at the time, that was real estate. I bought rental properties. I used, I would put down 20 to 25% typically on these properties. The bank would cover the rest, right? That's pretty cool. There's leverage there. You have to be comfortable with debt, but it was good debt because the tenants are paying the rent, which covers that mortgage, right? So they're paying down my loan, and then there's cash flow at the end of the month that I could use now to pay bills, live, and survive. It was money that was accessible. There was a lot of tax benefits, and you also get the appreciation. There's a lot of benefits to real estate, right? So I felt I could get more. I controlled the asset more, right? Because I could choose the areas that I invested in. I could choose the property. I could control how it was operated, what updates to make to get the most return on my rent. those were all things that I knew I could control. I couldn't control what happened in the stock market. I have no control, right? And I want a little bit more control. I was getting, I don't know, it was 10 to 14% cash on cash. And then when you layer in the appreciation and the depreciation, all that stuff, I mean, you could be 15 to 20% return while the stock market's doing 9 to 10, right? Better return, have money that's accessible immediately. That was my choice. A lot of people don't want to be a landlord. They don't want to own rental properties. Cool. Max out that 401k. Pay off low interest rate debt. This is where we come back to, is like, once all that stuff's maxed out, what do you do left? And it's not easy to get to the point where you got the cash flow and the means to max everything out. What's left? This is low interest rate debt. I actually disagree with this one. 2 to 3%. I don't, my personal opinion is if you've got a home mortgage that's below what the S&P 500 is doing, you're better off investing that money into the S&P 500, into the Qs, into real estate, into Bitcoin, because it's going to outperform that. Yes, you still have a mortgage, but those investments are creating more money than the mortgage cost itself. You're coming out ahead, right? That's my personal opinion. Then invest in taxable index funds. Pay off your mortgage. Okay, I 100% agree with this. Invest in taxable index funds because this money is accessible now. Something happens in your life, you can sell it. You gotta pay capital gains. And a lot of times in long-term capital gains, you can access it. You can pay the bills. You can live. You can buy this stinking country bagels and gravy with it if you want. You can't buy anything from your 401k until you're of age to take distributions, right? So I think that's a great one. I don't like paying off your mortgage early. That's just me. I think if you've got a 2, 3, 4% mortgage, I know they're a lot higher now, you should be able to outrun that number, okay, in the investments that you're making. And then just take the money you're making there and there you go. So that's my opinion. So then that's the sequence. That's it. There's 10 steps. I agree with most of them. There's 2 of them I didn't follow. I didn't finish maxing out the 401k. I didn't pay off low interest rate debts because I could outrun that number. And I don't like paying off mortgages early because, again, the number's low. I think I can outrun a 3 or 4% return in the stock market, a 3 or 4% return in real estate, a 3 to 4% return in Bitcoin, right? That's the strategy that I took. So now we're going to get to the Bitcoin itself. When do you invest in it? Okay, so let's start at the top. Build up an emergency fund. I agree with that. Okay, contribute to your 401k. Not likely to have the ability to buy Bitcoin typically. Maybe you can buy MSTR, right? Might be an option, but you're usually more limited in the 401k. But it's a 100% guaranteed return. Take it, okay? Then pay off the credit card debt. Yeah, not bad. That's something different. That's not Bitcoin. Pay off higher interest rate debt. Maybe. I mean, the whole goal is just get debt free. Like, that's the goal. Like, get all that stuff. Don't get yourself in those situations. I get it. You come out of college, you got to pay those things off. I get all that, right? But here's the cool part. Max out your HSA. You need to figure out what portion of your net worth you want towards Bitcoin. You might start lower. You might start at 1%, 2%, 5%. But you have to be educated, right? And what I've found is the more time people put into educating themselves about Bitcoin, the further they go down the rabbit hole, their conviction builds, and they just more and more and more of their investments go towards it. It's a black hole. It's just eating up all of these assets because it's outperforming them, okay? So here's a look at, we looked at right here. This is a look at SPY and triple Q. More volatile. I like triple Q because you're gonna follow the same trends. You're gonna get more juice out of it, but you got to be able to handle volatility. And if you can handle volatility, look at what Bitcoin does. This is the S&P 500. This is triple Q. Bajoinga! This is unbelievable. This is unreal. The types of returns that you are getting from Bitcoin, way more volatile. But even through the volatility, you are outrunning all these other assets astronomically. So you have to understand, probably you're going to start, because you have to, in something like SPY or an ETF or an index fund like triple Q or whatever you have. Those are your only options in the 401k. In an HSA, there's a lot more flexibility usually, and you can buy index funds for Bitcoin. I think you need to have a base, right? You should probably have a base in something secure and grow into it. I'm not saying everybody starts off as a Bitcoin maxi, right? Only having Bitcoin. I think if you're starting off, it's not a bad idea to build a really good base with some of these traditional assets. But by doing that, you're creating the comfort level saying, hey, if I'm putting $250 a month for 40 years away, I'll be a millionaire, okay? And if you want to juice it and get a greater return, maybe you start to explore Bitcoin. Now, here's what's going to happen: is you're going to start at a few percentage, and it turns into 5%, 10%, and then it grows of how much you're allocating towards it. And then Bitcoin outperforms things so much it actually pushes up your portfolio mix way higher, anyways, just because it's outrunning all the other assets out there. Okay, so you can typically, within an HSA, you might have access to MSTR. You've heard me talk about that. You might have access to MSTY. You've heard me talk about that. You likely have access to IBIT, FBTC. There's all these different ETFs that track Bitcoin. So 10% in Bitcoin is a 10% return in an ETF. But the cool part is, just like Bitcoin, you can buy these fractional shares of Bitcoin by $1. Well, these shares, for example, like the Fidelity FBTC, $81 right now per share. Cool. That's manageable. And so that's a way to get some Bitcoin exposure and really get those outsized returns. Okay. Then we're going to roll into max out your IRA. Again, maybe you go SPY, maybe you go the Qs. In there, you typically have access to MSTR or a little bit of Bitcoin. The reason I like Fidelity is just about all the other offerings, they have their Bitcoin held by Coinbase. Good company. It's kind of a honeypot, right? If something happens, a whole bunch of people are going to... There's a lot of funds there. Fidelity manage their own... they've got their own cold storage. I think it's a little more secure. I'm more comfortable with that. That's just me. Again, you have access to Bitcoin through your IRA. Look at all this stuff. We haven't even gotten to the point of talking about buying Bitcoin directly, owning the greatest asset, the underlying asset, and then putting it in cold storage. Because we're using the traditional tools that have tax advantages, okay? So your 401k is tax advantaged. You might have some Bitcoin exposure available. Your HSA is the most tax advantage account possible to have. You can typically, usually almost every time, get Bitcoin exposure. You have an IRA. You can almost always get Bitcoin exposure. Tax advantaged. Okay? I have chosen not to do this because I think Bitcoin will outperform all these other traditional assets going forward. So maybe you buy some Bitcoin, right? Pay off the low interest rate debt, all that kind of stuff. Here's the other piece, is invest in taxable index funds. Some people say, I don't like the tax stuff. This is where it comes back to one of my videos I spoke about, where I look at it as three different... I'm going to take some traditional ways to save, and I'm going to compare it to Bitcoin and how to get access and exposure to each of them. So a lot of people have a savings account, right? Great. I view that as Bitcoin in cold storage. Buy Bitcoin directly, put it in cold storage. There you go. There's your access. That's your savings account. The goal is not to touch that, okay? You're saving. Then make sure you have your cash available, right? All that stuff. You have your some traditional assets to make sure you're set for the future. But this is all like in addition. Like when you say, hey, I'm set, what do I do next? In my opinion, self-educate on Bitcoin. Again, this isn't financial advice. This is just educational options. And then you can almost use in a taxable brokerage account, you can buy Bitcoin in an ETF, and then that's what I would consider a checking account, because you can sell it at any point in time. all the tax stuff is already handled on your behalf by the brokerage firm, and you're good to go, right? And then MSTR is a way to get additional volatility, but additional potential upside, because they own 540,000 Bitcoin, right? Leveraged. And so it's a leveraged Bitcoin play, and that's a way to, again, juice some of your returns on top of the already amazing Bitcoin returns. And then you just decide if you're comfortable with a level of debt or not. So this, I think, is one of the best resources I've ever found, the correct order for investing your money. And then I would just recommend you got to really self-educate on Bitcoin. I don't want people just aping in. I don't recommend that. I think you really need to build the conviction, and that is simply through studying the history of money, reading the Bitcoin Standard, listen to some Michael Saylor podcast, reading the white paper. Just go down the rabbit hole. Ask ChatGPT, what are the 5 best resources I should look at to better understand Bitcoin, right? The cool part is you can access Bitcoin through traditional tax-advantaged accounts for the most part, and then you obviously have any brokerage accounts, non-tax advantage accounts, but those are the most liquid you possibly have. So I hope this was helpful. A shout out to mymoneywizard.com. They helped me early on in my journey. Wanted to share that resource with everybody. Like and subscribe below. Keep stacking those stats and stay sovereign. Enjoy.